while the entire crypto community is calculating what $60 trillion does to the price of XRP. Ripple just quietly joined the one thing regulators have been demanding for a decade. And that move matters more than the trillion-dollar number everyone is talking about. Welcome back. Had you heard about what Ripple just joined before today? Drop a yes or a no in the comments right now. I read every single one. This is not financial advice. This content is for educational and informational purposes only. Always do your own research before making any financial decisions. If the kind of institutional analysis we cover here is useful to you, hit the like button. It helps this reach more people who need to see it. Now let me walk you through exactly what happened and what it means for the thesis you have been holding. But this is the part almost nobody understands. Every major crypto channel this week led with the same headline: $60 trillion in global retirement accounts sitting at zero allocation to digital assets. If you have followed this space for any serious length of time, you understand immediately why that number commands attention. Today we are starting somewhere else, with the development that most people scrolled past because it does not have a price tag printed next to it. Ripple just became a founding member of the TRM Labs Beacon Network. If that name means nothing to you right now, that is exactly why we are talking about it. The Beacon Network is described as the first real-time crypto crime response system. Read that again. The first real-time crypto crime response system built to unite the crypto industry and law enforcement in combating illicit activity across digital asset networks. Take a moment to consider what that actually means and why a company like Ripple, the organization behind XRP, would make this a strategic priority right now in the exact week the Clarity Act is moving through the Senate. And this is where the story becomes dangerous. For years, not months, the central argument from banks, regulators, and institutional compliance departments against working with digital assets has been consistent. They cannot use these assets if they cannot track illicit activity. They cannot integrate these networks if they cannot demonstrate compliance to their own regulators. They cannot take counterparty risk on something they cannot audit in real time. That objection has followed Bitcoin, Ethereum, XRP, and every other major digital asset into every serious boardroom conversation about adoption. It has slowed bank partnerships. It has delayed legislative action. It has given regulators the easiest possible reason to say no. And to keep saying no, the Beacon Network is a direct answer to that objection in practical operational terms. When law enforcement and crypto industry participants are connected inside one real-time system, the transparency that regulators have demanded stops being theoretical. It becomes infrastructure. By taking a founding seat at that table, Ripple is not responding to a lawsuit. It is not reacting to a regulatory threat. It is positioning itself at the front of the system that makes compliance possible before the rules requiring that compliance are even finalized. That is the difference between a company that waits to be regulated and a company that helps construct the environment in which functional regulation can operate. Most crypto companies are still in the first category. Ripple is increasingly operating in the second. Now here's where things get serious. The analysis around this move is clear. Ripple's position as a founding member demonstrates a commitment to proactive compliance, transparency, and long-term legitimacy in the crypto industry. Regulators and lawmakers have regularly criticized crypto for its role in enabling illicit finance. By joining the Beacon Network, Ripple is demonstrating what observers are calling a solution-oriented approach, addressing the objections of global regulators, building the trust that supports future integrations and institutional partnerships. The move also protects the XRP ecosystem directly. Any digital asset involved in large-scale payment networks is a potential target for bad actors. Ripple's involvement in this system helps secure that ecosystem, safeguarding its reputation and its utility in real-world XRP payments. There is another layer to this that connects directly to something Jenny Johnson, the CEO of Franklin Templeton, described publicly. She spoke about what blockchain transparency means for oversight bodies, the ability to verify transactions in real time, to see what is happening on a network as it happens, to apply AI to that data and surface irregularities the moment they appear. Placed alongside the beacon network, what emerges is a picture of Ripple not just building the payment rail, but helping build the compliance layer that every serious institutional participant has said they need to see before they can move. And what happens next changes everything. These two things, the beacon network and Franklin Templeton's public description of the next financial system, are not separate stories. They are describing the same infrastructure from two different vantage points. The question underneath all of this is the one most people are not asking yet. If Ripple is now co-building the compliance architecture that regulators say they need, and if the CEO of Franklin Templeton just went on record describing exactly how blockchain redefines settlement, transparency, and operational cost across the entire financial system, what does the allocation math on $60 trillion in retirement capital actually look like when the last serious regulatory objection starts to fall away? Because once you understand what compliance infrastructure actually unlocks, you realize the trillion-dollar question was never whether the capital exists. The question was always whether the regulators would let it move. The capital has always existed. The objections to moving it were the only thing blocking the flow. And the beacon network, the Clarity Act, and the institutional product layer Franklin Templeton is building are simultaneously dismantling each of those objections in parallel. But this is the part almost nobody is connecting. The $60 trillion figure is worth understanding in specific terms, because what it implies varies significantly depending on which assumptions you apply. And the assumptions themselves come directly from the data. $60 trillion in global retirement accounts. Current allocation to digital assets from those accounts: 0. That is the reported figure, not a rough estimate. 0% of $60 trillion has any exposure to digital assets right now. Every 1% allocation from that $60 trillion adds approximately $3,000 to Bitcoin's price directly. The argument is that even 2% would be conservative, because all of that capital is currently sitting inside a monetary system where the authorities managing it have explicitly stated their intention to depreciate the value of the currency by 2% annually. Your savings denominated in something designed by official policy to lose purchasing power every year creates a structural case for moving a portion into something outside that system. The case is mathematical, not speculative. For XRP, the numbers look like this. 1% of $60 trillion is $600 billion. If $600 billion flows into XRP at current liquidity levels, the flat rate price impact is approximately $12.96 per XRP. That is the flat calculation, no market dynamics applied. Now here's where things get serious for the liquidity math. Markets do not work that way. When fresh capital enters a market and needs to absorb existing supply, the effect multiplies, because available liquidity cannot absorb large inflows at a constant price. The mechanism is simple. As capital tries to acquire size, the available supply at each price level gets consumed. The price has to rise to unlock supply at the next level, and the next, and the next. until the inflow finds its equilibrium. With a 25 times multiplier, which is a relatively conservative assumption for an asset with the supply compression we are seeing on XRP. The resulting price is approximately $255. With a 50 times multiplier, the figure approaches $500. With a 100 times multiplier, it approaches $1,000. These are not predictions. They are the arithmetic of what large capital flows do to constrained liquidity. The same mathematics that have applied to every asset class when institutional capital moved at scale into a market not built to absorb it quickly. The same mathematics that produced the Bitcoin ETF inflows, pushing Bitcoin from $30,000 to $100,000 in 18 months. The same mathematics that have produced every supply shock-driven repricing in modern asset history. The math is the math. The variable is not whether the dynamic plays out. The variable is what the multiplier ends up being when the inflows actually arrive. And the multiplier depends on how compressed the supply is at the moment the inflows hit. And the supply right now is the most compressed it has been in this asset's entire history. And this is where the story becomes dangerous to dismiss. The trajectory of institutional adoption is already visible and already moving. Norway's sovereign wealth fund, the world's largest, holding almost $2 trillion in assets, has been increasing its exposure to Bitcoin and digital assets. By Norway's own scale, it is still a rounding error in their portfolio. But when the world's largest sovereign wealth fund begins allocating even at rounding error levels, the signal that sends to every comparable institution on Earth is not a rounding error at all. It is a green light. Harvard's endowment, described as the world's largest endowment, is now buying Bitcoin. When the largest of its category moves, it opens the door for every comparable institution that has been waiting for someone of sufficient credibility to go first. Other endowments, other sovereign wealth funds, other pension managers who have watched from the sidelines because no one credible had moved yet. The CEO of eToro, a major trading platform that has been in this space since the beginning, offered a retrospective worth sitting with. His board pushed back for 4 full years when the company went all in on Bitcoin, beginning in 2013. By the end of 2017, 95% of their clients were actively trading Bitcoin, XRP, and Ethereum. The company had listed Ethereum when it was trading at approximately $4. His view now. We are still at very early stages. Read that one more time. We are still at very early stages. That is the perspective of someone who has been inside this market through every previous cycle, who has watched the institutional adoption curve advance through stages most retail holders have never sat with directly. And his read is that we are still at the beginning of what this transition produces. But this is the part almost nobody is sitting with. Think about a person in their early 60s who built a retirement account over 35 years through discipline, consistent contributions, careful decisions, no dramatic moves. That account exists today inside a monetary system where the official policy is 2% annual depreciation of the currency it is denominated in. The question they are beginning to ask, the one that major institutions are beginning to answer on their behalf, is whether a portion of what they have built belongs in a structurally different system. $60 trillion of that question is currently waiting. And Franklin Templeton, one of the largest and most established asset managers in the world, has already filed for 4 crypto ETFs: Bitcoin, Ethereum, Solana, and XRP. Those 4 were not chosen casually. They were selected specifically by a firm whose moves other major institutions watch before they act. And their CEO said it publicly. Not all cryptos are created equally. Focus on the assets with real utility and a real use case. She then described the structure of the next financial system in terms that anyone who has ever worked in financial services would recognize immediately. Atomic settlement. Transactions that settle right away, not in overnight batch processes. The New York Stock Exchange closes at 4 p.m. every afternoon because every participant needs that window to reconcile their records. Blockchain eliminates that reconciliation window entirely. Smart contracts that execute without human intermediaries, removing both error and the opportunity for manipulation. Transparency that regulators can audit in real time, with AI on top to flag irregularities as they appear, rather than months later. And fees in asset management going one direction, down. Now here's where things get serious for the operational reality. These are not aspirational statements. This is the operational description of what blockchain-based settlement infrastructure actually does. The CEO of one of the largest asset managers in the world just described the next decade of financial services architecture on the record. Publicly. With the names of the specific assets her firm has filed ETF products for. When the most established asset managers on earth are publicly describing the next financial system in terms of what the technology actually does, and when they are filing products specifically built on XRP and a small handful of other assets, the conversation is no longer about whether digital assets get integrated into the institutional system. The conversation is about which digital assets get integrated and on what timeline. The CEO of Franklin Templeton was careful with her language. Not all cryptos are created equally. Focus on real utility, real use cases. That language is doing real work. It is excluding the long tail of speculative digital assets that do not have institutional infrastructure built around them. And it is naming the assets that do. Those assets are the ones positioned for the institutional capital that has been waiting on the sidelines. And what happens next changes everything for the structural contrast. Here is the structural contrast that sits underneath all of this. Two companies currently hold over 51% of Bitcoin's mining power. That is the reported figure. The question it raises is a legitimate one. What happens to a network when a single entity controls which transactions are approved and which are not? What is stopping a country with the industrial capacity to spend hundreds of billions of dollars on mining infrastructure from attempting to reach that threshold? That question does not have a reassuring answer. And it points to exactly why the CEO of Franklin Templeton was careful to say that not all cryptos are created equally. The infrastructure characteristics that make a digital asset usable by the institutional world are not uniform. Different consensus mechanisms produce different decentralization profiles. Different supply distributions produce different liquidity dynamics. Different regulatory positionings produce different institutional risk profiles. XRP's consensus mechanism does not have the mining concentration risk that Bitcoin currently exhibits. The validator distribution on the XRP ledger has been operating for over a decade across institutions, universities, and independent operators globally. The network does not face the same kind of single point of failure question that the Bitcoin community is now beginning to grapple with publicly. That structural difference is not a marketing point. It is a real consideration for institutional allocators who are evaluating which digital assets they can deploy meaningful capital into, without taking on concentration risk they cannot manage. Now here's where things get serious for the Clarity Act timing. The named question worth carrying forward. Senator Cynthia Lummis has stated publicly that the Clarity Act, the market structure legislation determining which digital assets fall under SEC jurisdiction and which under CFTC jurisdiction, is targeted to reach the president's desk before the end of the year. Implementation after passage could take anywhere from a few months to a full year for rulemaking and enforcement to begin. The bipartisan support required is the same kind of cross-aisle effort that produced the Genius Act. Once the Clarity Act passes and assets are classified, the question becomes which assets come out of that process in the strongest regulatory position. And what does that classification mean for the $60 trillion of capital that has been waiting for exactly this kind of clarity? The answer depends on which assets meet the criteria the legislation defines. The mature blockchain test, the decentralization profile, the validator distribution, the regulatory positioning across multiple jurisdictions, the compliance infrastructure that supports institutional auditing. XRP meets those criteria in ways that the surface-level coverage of the legislation is not properly emphasizing. The institutional positioning Ripple has built across the UK, the EU, the UAE, Japan, and now through the Beacon Network compliance layer puts XRP at the front of the assets, best positioned to benefit from the Clarity Act's framework on day one. And this is where the story becomes dangerous to underestimate. Let me bring all of this together. Because what is in front of you tonight is a picture that the surface-level crypto coverage is not assembling properly. Ripple became a founding member of the TRM Labs Beacon Network, the first real-time crypto crime response system designed to unite the crypto industry and law enforcement. A compliance infrastructure move, strategically addressing the single most consistent institutional and regulatory objection to crypto adoption: the inability to track, verify, and demonstrate compliance in real time. Franklin Templeton's CEO described the next financial system on the record: atomic settlement, smart contracts, AI-assisted oversight, fee compression. Her company filed 4 crypto ETFs: Bitcoin, Ethereum, Solana, and XRP. 4 assets chosen specifically by a firm whose moves other major institutions watch before they act. Norway's sovereign wealth fund is moving into digital assets. Harvard's endowment is moving into Bitcoin. The CEO of eToro looked back across the full arc from 2013 to 2017, when 95% of clients were trading Bitcoin, XRP, and Ethereum, and said we are still at early stages. These are waypoints on a trajectory. The trajectory begins with retail, moves through sophisticated retail, then to smaller institutions, then to large asset managers and endowments, and eventually to sovereign wealth funds. Every stage of that trajectory has already been entered. The question is which stage you understand you're currently watching. But this is the part almost nobody is internalizing. $60 trillion in global retirement accounts has zero digital asset exposure. The monetary authorities managing the system, those savings, are denominated in have stated their intention to depreciate the currency by 2% annually. The Clarity Act is moving through the Senate. The bipartisan goal is for it to reach the president's desk by end of year. The infrastructure required for large institutional capital to enter XRP is being assembled simultaneously on multiple tracks. The compliance layer through the Beacon Network, the regulatory classification layer through the Clarity Act, the institutional product layer through ETF filings from firms like Franklin Templeton, and the macro pressure layer. $60 trillion sitting in a depreciating system, waiting for the conditions that allow it to move. Most people in your life right now are not connecting these pieces. They are watching the price chart. They are reading headlines about Bitcoin reaching a level or pulling back from one. They are not sitting with the CEO of Franklin Templeton as she describes atomic settlement and AI on blockchain and fees going to zero. They are not reading about the first real-time crypto crime response system in history and processing what it means that Ripple helped found it. You are. And the distinction between tracking the noise and tracking the architecture is what has separated investors who understood what was being built from everyone who noticed only after the building was finished. Now here's where things get serious for the architecture read. Let me show you why this distinction matters in practical terms. The retail framework looks at a $1.45 price tag on XRP and asks, what does this mean for the next 30 days? The institutional framework looks at the same price tag and asks, what does this mean over the next 24 to 60 months? Two different questions, two different answers, two different positioning decisions. The institutional framework is the one being applied by Franklin Templeton when they file ETFs, by Norway when they allocate sovereign wealth, by Harvard when they expand their endowment exposure, by the institutional desks at Goldman Sachs that are already holding $153 million in XRP ETF positions across 4 issuers as a long-duration strategic allocation. That framework reads the Beacon Network announcement and asks the next order question. If compliance infrastructure is being built, the regulatory objections to institutional adoption are being dismantled. If those objections are being dismantled, the capital that has been blocked behind them gets to move. If that capital gets to move, the assets best positioned to absorb the flow benefit first. And the assets best positioned are the ones with the institutional infrastructure already deployed. XRP is at the top of that list, not because of marketing, because of the work that has been completed over the last decade. And this is where the story becomes dangerous to ignore. The Beacon Network announcement is the kind of news that does not move the price the day it lands. It moves the calculation of every institutional compliance department that has been evaluating XRP as a deployment candidate. And those compliance departments make their decisions on quarterly cycles, not daily ones. Which means the price impact of the Beacon Network is not visible today. It is visible in the institutional allocation decisions that get finalized during the next earnings cycle, the next mandate amendment review, the next product committee meeting at the major asset managers, which is exactly where the next wave of XRP demand will be generated. The retail holder who sees the Beacon Network announcement and thinks it is a minor compliance update is missing the structural significance. The institutional player who sees the same announcement understands it as the removal of a key objection that has been blocking their internal allocation conversation for months. That is the gap between the institutional read and the retail read. And the gap is where the asymmetric positioning opportunity lives for the patient holder who reads the institutional signals correctly. Now here's where things get serious for the final question. After everything we covered today, the question that matters most for your positioning is whether you're tracking the noise or tracking the architecture. The noise is the daily candle close, the intraday volatility, the macro print that came in slightly above or below expectations, the political commentary about which senator said what at which hearing. All of that is real. All of that affects the chart. None of it is the structural picture. Share this with someone in your circle who is only following domestic crypto news and has no idea what is happening globally. Stay informed. Stay positioned. Architecture doesn't announce itself. It just stands there, waiting for the day everyone realizes what was being built while they were watching the wrong thing. I will see you in the next video.